All right, let's jump right into this explainer. Today, we are decoding the absolute legendary success of Warren Buffett's and Berkshire Hathaway, and we're doing it by going straight to the source. We're relying entirely on the incredibly candid words of the Oracle of Omaha himself, specifically using his 1986 and 2007 shareholder letters as our ultimate guide. So whether you are a seasoned investor or just someone fascinated by the sheer mechanics of massive wealth creation, trust me, there is a literal masterclass waiting for us right here.
I want you to just wrap your head around this number for a second. A 400,863% overall gain. That is the almost incomprehensible scale of their compounding success between 1964 and 2007. To put that into perspective, during that exact same time frame, the S&P 500, even if you include dividends, gained just 6,840%. That 400,000 plus figure, it is absolutely not a typo. It is the real-world result of decades of hyper-disciplined, relentlessly contrarian capital allocation.
And honestly, this famous quote brilliantly captures the foundational mindset you need to even come close to those astronomical numbers. Buffett doesn't look at outbreaks of fear and greed as market indicators you should follow. No, he treats them like unpredictable, highly contagious market diseases. The goal isn't to try and guess when the disease is going to strike, because you can't, but to react to it completely rationally. So when the market is euphoric and totally uncoupled from reality, you get cautious. But when absolute panic sets in, well, that's exactly when you make your move. So what are the actual mechanics behind this phenomenal success? We're going to uncover the playbook by walking through 5 core chapters: decoding intrinsic value, great, good, and gruesome businesses, moats and free money, the cash flow fallacy, and finally, the billion-dollar mistakes. Chapter 1, decoding intrinsic value. This is the single metric that truly matters when you're trying to figure out what a business is actually worth. You see, there is a massive, fundamental difference between book value and intrinsic business value. Book value, that's just an accounting number. It's super easy to calculate, it's exact, and it sits right there on a balance sheet. But intrinsic value, that's a much softer, highly nuanced number, and it's the one that actually matters to owners. Why? Because intrinsic value accounts for all the unrecorded economic value. Things like having an exceptionally talented management team. Honestly, 2 equally well-informed people could calculate a company's intrinsic value and come up with numbers more than 10% apart. But even as an estimate, that soft number has to be your North Star. Speaking of that unrecorded value, a massive chunk of it comes directly from managers who have what Buffett loves to call occupational fervor. Basically, they think entirely like owners. To really hammer this home, Buffett tells this fantastic little anecdote in his 1986 letter. He talks about a Catholic tailor who drained his life savings just to travel to the Vatican. When he finally gets back, his parish is buzzing, right? They ask him, "Tell us, just what sort of fellow is the Pope?" And the tailor's utterly obsessed, single-minded response, "He's a 44 medium." That exact kind of passionate obsession is exactly what Berkshire wants in its managers. Chapter 2, great, good, and gruesome. Let's break down the anatomy of different businesses to see exactly where Berkshire decides to deploy its massive capital. Basically, Berkshire looks at businesses as if they were savings accounts, and they sort them into 3 distinct buckets based on how much cash they chew up in order to grow. First up, you have the great business. This thing pays an extraordinarily high interest rate that actually goes up over time, and it does it without needing major cash injections. Next is the good business. It pays an attractive rate, sure, but you have to keep dumping capital in to get it. And finally, you have the gruesome business. This one gives you terrible returns and acts like a financial black hole, constantly demanding more of your money just to stay breathing. Let's ground this in some real numbers. Take See's Candies. Between 1972 and 2007, Berkshire only had to invest an additional $32 million in capital to fund its growth. But in 2007 alone, See's generated $82 million in pre-tax profit. It's a literal cash machine with almost zero capital requirements. That's a great business. Now, contrast that with Flight Safety. Fantastic company, absolutely, but it demands huge reinvestment. To generate $270 million in profit, it needed over $1 billion in fixed assets, mostly super expensive flight simulators. So it's a good business, but very much a put up more to earn more scenario. And to perfectly illustrate a gruesome business, look no further than the capital-destroying pit that is the airline industry. Historically, growth in this sector has actively repelled profits. A business that grows fast, needs a ton of capital, and earns basically nothing, that is the ultimate trap. And hey, Buffett is completely honest about falling for this himself with U.S. Air preferred stock back in 1989. He learned the hard way that finding a durable competitive advantage in airlines is pretty much an illusion.
Chapter 3, Moats and Free Money. We are now getting into the real secret weapons, the actual mechanics of how Berkshire funds these massive acquisitions.
The absolute core engine driving Berkshire Hathaway is a magical little concept called float. When you pay your insurance premium, the insurance company just holds on to that money until you file a claim. That temporary cash, that's float. And if the insurance company collects more in premiums than it pays out in losses and expenses, meaning they break even or profit on the underwriting, that float acts as 100% free money that Berkshire can go out and invest. And the growth of this float has been nothing short of explosive. Back in 1967, they were working with about $18.5 million. Jump to 2007, it had ballooned to an unbelievable $58.7 billion. This constantly growing, massive pool of zero-cost capital is literally the financial firepower that bankrolls Berkshire's entire operation. But listen, generating all that cash is only half the battle. To protect the investments they buy with it, a business has to have an economic moat. The brutal reality of capitalism is that competitors will relentlessly attack any highly profitable business. An economic moat is your defense barrier. Maybe it's being the absolute lowest cost producer or holding an insanely powerful global brand that fends off those attacks. Without a durable moat, any high returns you see are just a temporary mirage. The ultimate textbook example of this is Geico. Their rock-bottom operating costs are the moat. Because they run so much leaner than their competitors, they can offer far cheaper insurance, which wins them more market share, which in turn generates even more float. And the management team? Their daily obsession is finding ways to widen that moat by driving costs down even further, heavily fortifying their economic castle. Chapter 4. The Cash Flow Fallacy. All right, we're going to get into the accounting weeds for just a minute to bust open some massive illusions peddled on Wall Street. Buffett sets up this fascinating quiz in his 1986 letter. He gives you the financials of two perfectly identical companies, Company O and Company N. They have the exact same sales, the exact same wages, the exact same taxes. But Company N reports way lower earnings. How is that possible? Well, Company N is the business after Berkshire bought it at a premium. That purchase triggered GAAP accounting rules, forcing them to write up asset values and take huge depreciation charges. The actual underlying economics of the business didn't change one single bit, but on paper, the reported earnings completely plummeted. So, to cut straight through this accounting illusion, Buffett argues you have to calculate what he calls owner earnings. You take those reported earnings, you add back the non-cash charges like depreciation, but, and this is the absolute most critical part that Wall Street pitches always seem to conveniently leave out, you have to subtract the average capital expenditures needed just to maintain your current competitive position. As Buffett jokes, you can't just ignore capital expenditures. Unlike teeth, if you ignore them, they won't just go away. Your business will fundamentally decay. You have to apply this exact same focus on underlying economics when you look at things like corporate tax changes too. The letters make a brilliant point. Corporate tax cuts aren't just universally absorbed by every company. If you own a strong, unregulated franchise with a massive moat, a corporate tax cut drops straight into the owner's pockets. But if you're operating in a weak, hyper-competitive industry without a moat, the invisible hand of the free market will force you to pass those tax savings straight onto the consumer by lowering your prices. You really need to know which type of business you actually own. Chapter 5. The Billion-Dollar Mistakes. Time for a quick reality check on hubris and humility, proving that even the greatest investors to ever walk the earth aren't immune to huge blunders. And Buffett? He is remarkably transparent about his. Let's talk about the Dexter shoe disaster. In 1993, Buffett bought Dexter for $433 million. He truly believed it had a durable competitive advantage. It totally didn't. That advantage vanished almost overnight when faced with foreign competition. But the real tragedy, the real gut punch, he paid for it using Berkshire Hathaway stock. By using shares of an incredible compounding compounder to buy a failing business, that initial $400 million mistake snowballed into a $3.5 billion unforced error as Berkshire's stock skyrocketed over the years. Injecting a little bit of country music wisdom, Buffett uses this classic quote from Bobby Bear to perfectly sum up the harsh reality of waking up to a terrible acquisition. You go into the deal completely blinded by optimism, only to wake up later and realize that gorgeous economic moat you thought you saw, it was completely non-existent.
It's an incredibly powerful lesson in investing humility.
As we wrap up this explainer, I really want to leave you chewing on this final thought. The Oracle of Omaha built a legendary financial empire by ruthlessly identifying intrinsic value, demanding wide economic moats, and using free float to bankroll the whole shebang. Yet even he made multi-billion-dollar unforced errors. So if that's the case for him, how continuously are you evaluating the true intrinsic value and the moats of your own investments? Are you actively separating the great businesses from the gruesome ones in your own portfolio? Thank you so much for joining me on this deep dive into the Oracle's playbook. Keep questioning, keep learning, and for sure, keep checking those moats.